Okay, thank you everybody for joining us. While we've got people logging in here, I'm going to do the shameless commercials. fpfeaz.org, fpfeaz.org. That's a great website for you to go to get the full class schedule, and we've got on demand on here as well. So on demand, we've got a neat little series with the Social Security Administration, as well as understanding required minimum distributions, which was last month's class. We'll get that switched over to this class as well. All right, everybody. So we've got the class of the month. You can always go back and watch, but I'm going to jump over to the YouTube channel. I create 10, 20-minute type videos every single week and throw them on here. Grayson does some market reviews on here. There's lots of wonderful stuff. So jump on YouTube and search for Planning Before Investing. Look for our logo and our scary faces there. Subscribe to the channel. We've got lots of wonderful content constantly going on there. Again, that's Planning Before Investing on YouTube. It's full channel, lots of wonderful stuff. If you are looking to watch old classes, you can go to our website, Secure Estate Solutions, so sesweb.net, sesweb.net. On there, you can find under the Education tab not only our class schedule, but you've got full video classes right there. We've been recording them and posting them for the whole year, and we'll start replacing them as we've updated and put new classes in there. There's lots of great free reports, but first the classes. You got January's Harnessing the Power of Roth on through the whole year of different topics that we've done on there. So you can always jump on there and rewatch classes. The free reports, I'm always vetting and putting new reports on there, white papers, some people call them, lots of great stuff, and we'll have new content all the time on there. And certainly if you want an appointment, you can look for that on here, or you can go to yourinvestmentcounselor.com, yourinvestmentcounselor.com. That's where you find the ability to look at my calendar, Grayson's, our CPAs. You can jump on and do a free 30-minute meet and greet with me as well. So Your Investment Counselor, you just click on free 30-minute meet and greet, and you will be connected to my calendar. All right, all of that is done. Now let's jump into the class of the month, Essential Estate Planning. I try to simplify this for everybody. Everybody needs to understand the difference between a will-based plan and a trust-based plan. Virtually every lawyer wants to push you into a trust and overcomplicate your situation. I'm going to try to uncomplicate it. It's important that we understand how this stuff works so we can then discern the difference and know what's better for our own situations. That's the goal of today's class. So before we begin, the Foundation for Personal Financial Education, that's that FPFEAZ website, az.org. That's the nonprofit that I run here in Arizona. The whole idea of this is to provide financial education without the sales and biases that we find out there. So hopefully you find this to be a different atmosphere and you keep coming back every month. We have a different topic. Share it with your friends. Let people know about us. We just want to make sure that you're getting good, solid information that pertains to the whole retirement world. My background, I've been running the Arizona chapter for, long time, more than 10 years, 10, 15 years. Pandemic throws me off a little bit. Master's degree from University of Arizona, focused in finance. I have a CFP, Certified Financial Planner from Pepperdine University. And then I own a local family of companies that includes a wealth management firm and a tax firm. So I do have practical working knowledge in everything that we do education in. Believe it or not, in this topic, I'm not a lawyer. And you don't want a lawyer teaching this stuff because everybody needs a trust and they're just going to scare you into the trust and then they'll complicate it. So in this case, yes, I can prepare a lot of documents. We have document systems here, so I'm not giving legal advice, but I always want to make sure we're on the same page first, and then we assess your needs. If it's complicated, you need to be referred to a lawyer, but if it's not, then documents are usually all you need. So we'll discover that as we go through this. Legal disclaimer, everything we talk about is for educational purposes only. That's the idea of these classes. So use what you learn in our classes to work with your CPAs, financial advisors, attorneys, whoever it is that you need to help apply this to your situation. All right, so lots to talk about. Start with basics, just understanding the whole concept of estate planning. And then we're going to dive into a will-based plan and then a trust-based plan. And then we'll start wrapping it up. We'll talk about a few large estate considerations and some summarizing all this information at the end there. All right, so basics. What is estate planning? Well, it's the creation and preservation of wealth and distribution to heirs and charities. So really, what is this? Well, it's taking what you have and trying to figure out the most efficient way to get it to your next generation. It's maintaining control during incapacity. Okay. It's quick and cost-efficient wealth transfer upon your passing. And then it's protecting the beneficiaries from each other in some cases. And usually it's your fault anyways. So there's lots of things, and I got lots of YouTube videos on this. I just made one on how to uncomplicate things and lessen the problems that you leave behind. It's important. So what is your estate? A lot of people just think of the money they have. Well, don't forget the real estate. Don't forget the jewelry. Don't forget the, if you got valuable antiques, don't forget your cars, those Lamborghinis that are in your garage, insurance policies, all that stuff. We got to think about everything down to the pencils in your drawers. That's your estate. All right. It's the clothes on your back. So when should you plan your estate? Well, look, for most people, the answer is today. Tomorrow's too late, right? If you've experienced loss in your life, you then have that perspective of, yeah, it could come at any time. We're not really in control of this. So let's make sure we understand how these documents work. Power of attorneys. Very, very large misconception on how and when power of attorneys are usable. Usable because you're mental incapacity or you're a vegetable, right? You can't communicate, you can't make decisions for yourself. That's when those power of attorneys become usable, right? But notice, after death, they're not useful at all. And that's confusing for a lot of people. Well, wait a second, I was paying all the bills and then mom died and now I can't use the power of attorney. That's correct, you can't. Power of attorneys are no good after somebody passes away. Next, living will. What's a living will? That's not your last will and testament. That's your living will. Your living will says how you want to be cared for. Pull the plug, don't pull the plug. Breathing tubes, no breathing tubes. Feeding tubes, all that kind of stuff. Catastrophic illness stuff. So this is your essentially what I think is considered your medical directive. That's a better way to think about it. Your medical directive really includes this and your medical power of attorney, but this is the real meat of it. Power of attorney says, I need to follow the living will. The medical power of attorney says, I need to follow the living will instructions. Then, after you pass away, that's when your will comes out. The will is worthless before you pass away. It doesn't do anything while you're alive. That's what your power of attorneys and living will are for. Then your last will and testament jumps in after you pass away. Now, if you have a trust is meant to start the day you create the trust. It says what happens while you're alive. It puts you in charge of your estate, unless you want somebody else in charge. Right? It says what happens if there's mental incapacity. It says what happens upon catastrophic illness. It has all of the documents that take care of every situation from day one going forward, even through your passing. And the power of attorney, really, the executor jumps in as the power of attorney because the trust should own everything in your estate. And so, therefore, the executor shouldn't have to use a power of attorney because the wealth has all transferred to the trust. Okay, so we're going to discover the rules on how this stuff works and make it useful for you in this class. We're going to go through all these documents. So what is probate? Why are we all scared of probate? I had a client that had a trust that ended up having to go through probate because her deceased spouse had a very large stack of treasuries in his own name hiding in the back of the desk. She had a trust. She had to go to probate to get permission to get those into her name. Yeah, that's right. People with trusts still have to go to probate. But guess what? I had an attorney friend jump in and file the paperwork and, pay for all the fees, and they charged her, but it was, minimal amount. And he had that letter within a week that gave the Treasury the authorization to release the funds to the spouse within a week. Whereas I have a client with in the middle of a probate in New York, and we're 3 years in. So there's one of the reasons to worry about probate. You don't know what you're going to get. And I'll be honest, probate is where the court system takes over as opposed to an appointed person or a beneficiary or, anything. So if the courts have to jump in, this process is considered probate, okay, with a valid document. So let's not say will. It could be will or trust. With valid documents, you can still end up in probate. And in that probate, each state where stuff resides will have separate probates. And it's pretty simple when you have documents. When you have proper documents, you just have to wait in line, get in line. Court looks through the proper documents and says, well, here's what the wishes were. Here's what I need you to do. Here's the letter that will give you the power to go do those things. Okay? Without a will, oh boy, that's scary. The courts have to recreate everything. They don't know anything about you. They don't know who your heirs are. They don't know anything. So they got to put people in charge. They got to put a court-appointed people in charge. And anything that is administered has to be approved by the courts. So that's what's scary. What happens in probate? Well, each court where property is held will appoint personal representatives. So if you have a second home in Wisconsin and a home in Arizona, you're going to have two courts. You're going to have two representatives looking through all your stuff. They'll figure out who gets what. Wisconsin's responsible for this and Arizona's responsible for this. Boom. Now start going to work. Notify the public that your estate is being, that's right, just air the laundry out. We need to know who wants this stuff. Locate and value all the property of the estate, pay any debts and expenses of the estate. So everything will have to get paid out first. Distribute all of the assets of the estate for whoever they choose to give it to, however they choose to give it out. The courts make every decision. Now, if they have documentation of your wishes through a will or a trust, then guess what? It's a lot easier. It's less difficult. Okay? You have no docs. Holy cow. They're flying blind. It's not easy. It can take a long time. So, court remains in control during the entire probate of the estate. Any actions taken on behalf of the estate must be approved by the court. And costs, well, you got some hard costs, but then you've got 4 to 10% to these people that are trying to run and figure everything out and are in charge of these things. So it can get expensive. A few cases, well, Marilyn Monroe's estate took 18 years to settle, and her heirs only received $100,000 after all the costs and fees. And 18 years of it is quite a bit, right? Elvis lost 73% of his net worth to fees. It was a mess. Prince died with no documentation. That's just been a disaster. We're still working on that one. It's crazy. There's so many problems out there. James Gandolfini passed away, and he had documentation from a state that he wasn't even living in at the time, and it was faulty and messed up everything. By the way, all these docs are state dependent. So you move, you're going to need new docs. So your choices are really two different choices. You're going to need a will-based plan or a trust-based plan. Everybody needs one or the other. That's just the reality of it. Even the best laid plans, we got to have these, I call them backup documents, because you can do everything right and you may not need any of these documents. But the vast majority of people they miss something. Let's just put it that way. All right, so here's the thing. Will-based plans are going to be best for most. They're the most simple. All right, and nobody wants you to know that. The reason they're the most simple is because they're going with the custodian of the money. Where is it right now, or the stuff? And they're creating the most efficient way to get it directly to the heirs. They're not putting a middleman in the middle. You'll notice when we get to the trust-based plan, it's the same thing, except we're putting somebody in the middle. Okay, for a lot of people, it's more efficient to go from your IRA account directly to your heirs, as opposed to go from the account to the trust, then to the heirs. It's really that simple, right? So the will-based plan, when done properly, avoids probate. When done properly, avoids probate and is the most efficient way to get your stuff passed to your heirs. So the most important thing you have to learn is this: how property transfers with a will. Absolutely, unequivocally, the most important slide on this entire class. So important, I go through it twice. So here's the thing: proper titling, the ownership paperwork, right? Think about this. Your house has ownership paperwork. Your car has ownership paperwork. Every investment account has ownership paperwork, including your bank accounts. They all have ownership. Your grandfather clock does not have ownership documents. Nobody is maintaining the ownership documents of that, right? Your jewelry has no ownership documents. This is important to discern the difference. Real estate has ownership documents. Cars have ownership documents. All monetary accounts have ownership documents. Now, think about this. If it's joint tenants with rights of survivorship, the vast majority of all accounts are owned that way. Okay? Joint tenants with rights of survivorship. Only your IRA and Roth money is not. And then sometimes the crazy offshoot, different ways to hold titles, sometimes are different. Rarely. Vast majority, joint tenants with rights of survivorship. If one person passes away, the other one is still alive, ownership is done. No probate. You own the house, you own the bank account. If it's joint tenants with rights of survivorship and both your names are on there, then the one that passed away then already decided who owned it after them. So if you are on titling, there's no probate. It transfers that quick and easy. Next, beneficiaries. Beneficiaries come second. The priority totem pole here. Beneficiaries come second. Okay. The second most important part of this is all of your beneficiaries. All of your monetary, everything I just talked about, all of your money, everything, including your bank accounts, your investment accounts, your IRAs, your Roths, your 401ks, every single monetary account, your life insurance policies, all of them have beneficiaries. You're able to put beneficiaries on these accounts. These are called assets that transfer by contract. That is a beneficiary. And guess what? If you have a beneficiary listed properly, not my estate, my spouse, and you're not married, as long as you list them properly, I've seen some blank, I've seen some partially filled out, I've seen messes out there. As long as you have them properly filled out, they transfer without probate. Notice we haven't even talked about a will or a trust yet. These transfer without probate. No, guess what? Not only is all your money covered by the titling, but also the beneficiary designation, but so is most real estate. More than half the states in the United States allow you to put a beneficiary on your real estate. And a lot of the motor vehicle departments have a beneficiary form for your car. So now we're talking about most people's real estate. We're talking about cars. We're talking about all your money has been taken care of by these simple two things. It's that easy, right? It's that simple. Then we're going to go look at your will. then and only then. So if it has not been satisfied by the title paperwork or the beneficiaries, and we don't know what to do with it, your stuff, it's that vault of gold in your house. It is the accounts that you forgot to put anything on. Those treasuries we found in the back of the will is used to go into court and fix those problems, right? Because when somebody passes away, there's no court official that immediately goes and runs into the house and does accounting of everything. So you get these state limits of 90 grand, 100 grand, and that's what the lawyers like to use to tell you have to do a trust to avoid probate. And that's silliness. That's absolute silliness. My client with a trust had to go to probate because there was $100,000 worth of treasuries. The treasury would not release it without the court's permission. It's that simple. If you have 150 grand worth of gold sitting in gold jewelry, you didn't even realize it was worth that much. I mean, gold jumps to $4,000 or $5,000 an ounce, and all of a sudden it's actually worth something. There's no court officials walking through your house. Oh, let's add this all up. An Antique Roadshow comes through and says that's worth $10,000. That's worth $5,000. No. The kids come into the house, they disperse all the stuff. That's what they do. They either have a big yard sale or they go find the valuable stuff and stuff it in their pockets and run away. The will is there to settle the arguments in the courts if the kids want to argue. The will is there in case you forgot to put beneficiaries on your bank account. The will is there as a backup. That's what it's there for. Because if the title paperwork of, well, let's use beneficiaries. If the beneficiary of your IRA says it goes to Billy Sue, 100% to Billy Sue, and your will says split everything 50-50, the beneficiary wins. The will means nothing. Okay? Proper titling, first priority. Beneficiary designation, second priority. The will is third. I don't care what the will says for anything done properly above it. That's the reality of it. It's only in charge of stuff that wasn't done properly up here. That's all. That's it. And if you can transfer all your money, your cars, your real estate, really, what do you have left? The clothes on your back, the stuff in your house, and really, that's there to just in case the kids need somebody to settle the argument. If the will says 50-50, the courts are only going to look at that stuff. They're not going to look at stuff that was taken care of by the beneficiary designation or title paperwork. They're not going to look at it. They don't care. You go into probate and argue your case and say, I want this, I want this. Fine. I know you can't split that grandfather clock in half, and if you both want it, the courts might just say sell it and split it 50-50. The will is there to clean up the mess if needed. And hopefully it's not needed. Gifting is the lowest priority on this totem pole. This is what gets pulled out in the arguments. Yeah, but dad gave you 50 grand a year ago. Didn't give me anything. I should get 50 grand more. Careful with your gifting, especially late in life. Okay? All right. Now, let's look at these documents. The last will and testament, it nominates a personal representative. That's the person in charge of settling your estate. Somebody's got to know they're in charge. Somebody's got to go give the death certificates to the investment accounts. If you have a good advisor, our clients' kids all call us and we just jump in and do all the work for them. It's pretty simple. You know, again, you want to call the attorney and let them jump in and do it, fine. They'll charge you thousands of dollars to settle the estate. We get it done as quick and efficiently as possible. We don't charge. We want the kids as our clients. We're here to help, right? So nominates a personal representative in charge, typically, you know, one of the heirs. States which personal property goes to whom. So you can have a whole list of, you know, the grandfather clock goes to Billy Sue. You can list it out And if you have minor children, name a guardian. Maybe you got pets, name guardians of the pets, all those kinds of things. Okay. You can say if anybody argues, they get nothing, but it is only in charge of what you didn't do right on your beneficiary. So you can rescind their ownership of the grandfather clock, but you cannot rescind the IRA that you put direct beneficiary designations on. So that's your last will and testament. All right. Then you got a living will. Living will is life-sustaining treatment, comfort care. It addresses all of your medical decisions. It's how do you want to be cared for when you're not able to make those decisions? Okay. So it guides the medical power of attorney. Then you've got the advanced medical directive. Here in Arizona, we have a medical healthcare power of attorney and we have a mental healthcare power of attorney. Two separate documents. Sometimes lawyers draw them up in one document, but they're essentially smashing two documents together is all they're doing. Some states, it's just one overall medical power of attorney. They must be newer than 2006. They must be newer than 2006 because that's when HIPAA compliance came in. Okay, meaning who can I talk to and not talk to? They're not even supposed to talk to a spouse without a medical power of attorney. That, believe it or not, because of HIPAA compliance, they have to be careful about that. And some places enforce it, some don't. You know, obviously we're in fragile state if somebody's getting rushed to a hospital. A lot of the times the hospitals will talk to a spouse in emergency cases, but once things settle down, they're going to want to see that power of attorney. All right, financial power of attorney is the other one. The big thing about this is most people are going to do some form of springing. Springing means give me two doctor's letters that say I'm not of sound mind. Like, for instance, my mother-in-law's was springing. We had two doctor's letters saying she had Alzheimer's. You ask her if she had Alzheimer's. No, I just hit my head. I'm fine. She was perfectly fine in her own mind, but it was very obvious that she wasn't. So a lot of people are going to want that springing power of attorney, whereas good at any time is self-explanatory, meaning I trust my kid explicitly. They can jump in and take over whenever they decide they want to. Okay. So that's the big thing there. And you're going to check off on what they have the power to do or not do. Things like real estate transactions, you know, monetary investment account transactions, all that kind of stuff. And there's a whole long laundry list of things that you have to specifically sign off on in terms of the powers that they have. All right, so keys to a will-based plan for simple estates. Beneficiary deed state real estate ownership, meaning if you own real estate, and there may be a couple new states on here, but all of these states allow beneficiary deeds. And then there's some states that allow something called a ladybird deed. Not a big fan of those things, but the beneficiary deed states, these are pretty quick and easy when you have simple situations. If you want to complicate your situations, you may want to jump to a trust, and that's fine. There's nothing wrong with that. No business ownership, meaning if you're a business owner that needs to solve, you know, who's going to run the business or, you know, what happens to the business after you're gone, is it going to live on? That's getting very complicated. So business ownership ends up being difficult. Simple family dynamics, meaning, you know, special needs kids, that's going to cause a need for a trust. You know, having 8 kids and 2 are from separate marriages, and you know, you start getting complicated situations. That's when you're going to want to go to a trust. And then less than the lifetime estate tax exemption, which has rocketed over the last several years. We're up over 15 million each. So as long as you have less than that, there's no monetary reason. Some people think, oh, anybody with $1 million needs a trust. No, that's not. No. I've seen multi-million dollar estates settled with will-based plans. It's not a problem. Doesn't change anything. Proper titling. You got to make sure all of the documentation is correct. Beneficiaries, I'm going to tell you, is by far the most important part of a will-based plan. Going through every single account and making sure the beneficiaries are listed properly. So understand, just putting Billy Sue on there, sometimes not enough. You got to put enough identifiers. You need to put their social security, birth date. You got to make sure it's easy for these companies to disperse this money when you're gone. So there aren't questions, because if there are questions, then the custodian of this money is going to say, I need a court to give me approval to send this out. That's what they're going to say. So then you're in probate. So fill these things out properly. It gets so frustrated when I see these things not filled out properly. And that's because of mostly financial advisors that are lazy and just don't care. That's the problem. Most of these financial advisors aren't going to be there when you pass away. They don't care. You got to have this stuff filled out properly. Lineal descendants per stirpes. Well, that splits everything up differently if one of them passes away. There's lots of things you can add on to these beneficiaries forms to handle situations. You can even appoint a guardian of a minor's account. You can do a lot of things on these forms. So just know that a skilled advisor is going to be able to fill out these beneficiary forms properly and get them done right for you. They're very important. Consider life insurance, annuities, and reverse mortgages to protect assets. I always like watching people's eyes go, what? Well, look here. Here's the thing. Life insurance and annuities are creditor and lawsuit protected, and weirdly, reverse mortgages protect the equity in your home if done properly. Even our Medicaid system here in Arizona, the social workers will warn you that if you don't go get a reverse mortgage, then the lien from Medicaid is going to be on your house, eating up that equity. So look, there's a lot of things that can be done with these tools to help protect money for heirs. We actually had a client whose daughter moved into the house to care for her, and Medicaid paid the daughter and they told her, you have to go get a reverse mortgage. You're going to get kicked out of this house right away if you don't. So it helps protect for heirs in a lot of cases. So just know that with proper planning and proper situations, life insurance and annuities, again, creditor and law, you could die with $1 million in medical bills. That money gets transferred and it never touches the estate. California is a great state that goes after the estate to recoup costs that they paid for. They will go after you. But if it was transferred in life insurance or annuities, they have no right to that money. So there are things out there that will protect you as well. Have up-to-date documentation. Name a personal representative, right? Somebody has to know if a tree falls in the woods and nobody ever sees or hears it, did it really fall or did it really make a noise, whatever. But the reality is you can't pass away and nobody know that they're supposed to jump in and get stuff taken care of. They have to know where the documentation is. If it's in your safety deposit box, do they have access to that? And the answer is probably not a chance. It's very hard, especially after somebody passes away, to get into a lockbox. I watched it take a couple months for a client to get into his spouse's lockbox. So just know you got to have somebody in charge when you pass away, and they have to have access to your documentation. Great websites to get documents: LegalZoom, US Legal Forms. I can do them on most documents, most simple situations. You have to sign a disclaimer. I'm not giving you legal advice. I'm just helping facilitate the documentation. But if it's a complicated situation, I'm going to refer you to a lawyer. But I typically want to uncomplicate things. It makes it so much easier for your heirs. All right, so then let's talk about trust plans. Remember, I alluded to this. You want to make things more difficult, get a trust. And a lot of people's situations, we should have a trust. I don't have a problem with trusts. I just want to make sure you understand when you pass away, you're putting a middleman in. And that middleman, you have to assign somebody in charge, woman or man, but you know what I mean. We're putting an extra person involved here, which, look, when it's Chase, they're not concerned about your kids' arguments. They see a beneficiary, they're going to send the money out and they're done. And they walk away. You put a human being in there and you got kids arguing, oh boy, does this where it gets messy. So you don't want people surprised by your decisions. You want to communicate properly, not only to the person you're putting in charge, but to all your beneficiaries. They don't need to know exact dollars, how many accounts. They don't need to know any of that. What's left over, I'm going to be divvying up like this, and here's why. Okay? So I always tell people, if you're going to do a trust-based plan, don't surprise those beneficiaries. That's when problems ensue. Okay? You can think you're being as fair as possible, but if it's a surprise to the beneficiaries, you're going to cause a huge problem to the person you put in charge of your trust. That's not good. That's when problems ensue. So when you create a trust, you're essentially giving all your assets to the ownership of a trust, because guess what? A trust can't die. It's not a human being with a lifespan. So therefore, probate won't be needed, right? As long as you do everything properly. So let's go back to how property transfers when you have a trust. The first things first, proper titling, right? Proper titling. You need to change as much as you can to have the trust be the owner, not you. Meaning the ownership of the house needs to be owned by the trust. The car needs to be owned by the trust. The bank account needs to be owned by the trust. The brokerage account needs to be owned by the trust. The only things that can't be owned by the trust are things that don't have title paperwork or your IRA or Roth. We have to treat those separately. IRA and Roth can't be owned by the trust. That's transferring ownership. It's a taxable event. You're going to lose the tax status. You don't want to do that. Everything that you can have owned by the trust should be owned by the trust. So when you pass away, it's seamless. It's owned by something that didn't die. It doesn't need probate. Hence, if you have treasuries sitting in the back of your desk in your name, it doesn't have a beneficiary on it, it doesn't have the title paperwork in the name of the trust, yeah, it's going to end up in probate, because number 2 is the same beneficiary designation. Beneficiary designations are priority number 2 with a trust. If you have a trust saying one thing and a beneficiary saying another thing, the beneficiary wins. Beneficiary forms on your same accounts, all your money, every penny of your money allows beneficiaries. Transfer on death, that's a beneficiary. By contract, I want this money to go here. Boom, that's what it does. So if you have an account that has title paperwork and beneficiary, you put the title paperwork in the name of the trust and you double it up and say, I want the beneficiary to be the trust, just in case there's dumb people involved. So now you got 2 ways that it shows up in the trust when you pass away. The goal is to get everything to the trust that you can. Let's see if that paperwork, all the extra verbiage is jumping in here. So again, proper titling. When you have a trust, you want everything owned by the trust that you can. Beneficiaries point at all of the trust. I will put a big caveat on both of these. IRA and Roth, we go old school. You put the human beings or charities on the beneficiary designation on your IRA and Roth so you can maintain the tax status. We have too many problems out there shoving IRA money and Roth money through a trust. Even if the lawyer's the greatest in the world, these laws and rules change. And honestly, it's up to the custodian. If the account's at Charles Schwab, Schwab sees that the beneficiary is a trust, they don't have proper documentation on the trust, and they're tired of fighting with the heirs to get the proper documentation. They don't want to deal with their legal department. They're going to say, you know what? It's not going to a human being. I don't have the proper documentation. Even if I did, I don't want to send it through our legal department. I'm going to take 40% of this money, send it to the IRS, and write a check to the trust for 60% left over. They just un-IRA'd your money all at once. You go fight with the IRS to get your taxes back. That's what they're going to say. To avoid those problems, you don't want to lose your Roth status. That's tax-free. You don't want to lose your IRA status. There's way better ways to not pay that much in taxes. You got 10-year distribution rules. There's lots of things you can work with. Your heirs are going to need help with the IRA and Roth money. There's too many confusion of rules out there. So don't put your IRA or Roth account in your trust. Avoid that at all cost. Okay? Then, after you've done all your proper titling and beneficiaries, remember, IRA and Roth, keep it separate from your trust. Everything else, shove it in the trust. Then, whatever the trust has, they have your house, they have your bank accounts, they have all your investment accounts other than your IRA and Roth. Then the trust has all that and says what to do with it. You named who was in charge of this trust, and now it's their responsibility to disperse it as you laid out in that trust. So if you have 20 heirs and you're moving them around all the time, it makes it easier when you have a trust. If you got a difficult situation, you can accommodate for anything. You could say Billy Sue gets a quarter of the money on their 28th birthday, or Bobby gets half the money when he graduates college. Whatever. You can say anything you want. So the more complicated you want to make this, trusts can be written, but you'll have to pay for it, right? Complicated trusts are going to be expensive. So that's how all this stuff works. And again, gifting is a big no-no. Be careful about gifting later in life. That's what causes a lot of fights. And then if there's fights, probate. If you forgot to do something right here, if you didn't put the titling right or anything like that, yeah, that's probate. As a matter of fact, the trust has a very specific document in it to go handle probate for all the stuff you forgot. So let's look through these documents. The pour over will. Believe it or not, there's a last will and testament in your trust. And it says, whatever I forgot to put in my trust belongs in my trust. And its only purpose is in case you got to go to probate because an asset was forgot to put in the trust. For instance, a bank account. A bank account that you forgot to put TOD on, or you forgot to put the trust as the owner of the account on, because those bank employees are usually kids and they don't know how to do technical stuff. And you didn't want to fight with them. You tried it once and put it on the back burner and you didn't do it. You can tell, I see that all the time. Yeah, Chase is not going to transfer that money without a letter from the court. You can talk to me about state limits. It's not Chase's fault. Chase shouldn't just willy-nilly hand out money just because somebody says so. So yeah, they're going to want court approval. Well, you take this pour over will or last will and testament that's in your trust that says whatever I forgot to put in my trust belongs, and then you go through probate. And some states have simplified probates. You can have that letter within a week in a lot of cases. You don't really have to show up at court, or you just file all the proper paperwork and they expedite it, right? And then you take that letter to Chase and you get your money and you're good to go. Okay, so this document, your last will and testament, sometimes called the pour over will, this is literally there to scoop up everything you forgot to put in your trust. And this is, evidence of what I'm saying is actually true. I see just as many people in probate that had a will as opposed to a trust. It doesn't matter, will or a trust. It takes somebody messing up. That's it. All right. Then you have your living trust. It says what happens while you're alive and well. It says what happens when you become mentally incapacitated and what happens after your death. It names a person in charge of all this. It puts everything up in one pack. You're creating an entity. You're creating this entity. It's very important we look at it that way. This is an entity that then owns all your stuff. You name yourself as the CEO. You define what happens when you're not capable of being the CEO of your own company, and you put somebody in charge of it. Your spouse can be co-CEO. Co-person in charge. So if one of you passes, seamlessly, nothing really changes. You still have somebody that's there. But then you name somebody after that. There's lots of things that you can do. These documents can be handwritten. And then the same advanced medical directive, living will, financial power of attorney, all that stuff is exactly the same as the will-based plan. Okay? So Keys to a trust-based plan. Complex plans need an attorney with a knowledgeable advisor. So for instance, obviously I'm knowledgeable in my own situation. I could easily get away with just having a will-based plan because I know how to handle all of my things. But because I have multiple pieces of real estate, I've got business, I've got all that stuff, I knew how to simplify it on a basic trust. And I just went and used my doc system and pulled a trust and made it for myself instead of going to a lawyer and overcomplicating things. I have one heir. It's just that easy. I just got to figure out how to get it to that heir and name somebody responsible for it while she's a minor, which isn't much longer. So pick the right trust for you. There's lots of fun trusts that you can use out there, and there's one that's very useful. My parents have. I usually recommend it for late life marriages with separate heirs. It's a spousal access trust, an AB trust. So when the first passes, you put half the wealth in their trust, putting the groundwork for the surviving spouse to be able to use that money but not be dispersed fully until they both pass. So that's a fun little trust, and we'll bring some of those up in a second here. Fund your trust. This is where and why people end up in probate. They get the trust and they say, I'm done. I did it. I did my job. I did what I know. Oh, all the work you see you had to do on a will-based plan, you're still going to have to do on a trust-based plan. Getting the document is just the beginning. You have to go through all your accounts and change the ownership of the accounts. Change the beneficiaries of the accounts, all your bank accounts, all your real estate, automobiles, insurance policies. You've got to go through and point everything at the trust except your IRA and Roth account. Okay, so everything except your IRA and Roth account, you typically want to send them directly to your beneficiaries. Everything else goes to the trust. Carefully name your trustees. 2 is not always better. Backup. So name one and then have a backup to that one is a good thing. So just understand your trustees, people in charge after you pass, have to be willing to do it. And the burden you're putting on them is quite significant if there's problems or if you decide to manage from the grave, which means I only want to dole out 10,000 a year until the money's gone, or managing from the grave means I don't want to give it all upon my passing. I want it to continue giving to the heirs, the children, whatever the case may be. I have a client who is the trustee for her friend's trust because her friend didn't trust her kids. And so now my client has to manage this money and deal with this kid saying, I want more money, I want more money, I want more money. And she has to do it for the rest of her life. And I will tell you that she is doing a lot of swearing, and she knows she will never agree to do this for a friend ever again. So just know the burden you're not only putting on the heirs, but also what you're doing to the person you're putting in charge. So again, simple situations, try to not complicate it with stuff like that. You have to think about more of what you're leaving behind. You may think you're leaving behind a better way to distribute your wealth, but you're putting a burden on people that you may not realize you're putting that burden on. All right. So large estate considerations, big changes here. Back to 2011, we were only at 1 million, and we were all surprised at that. And now we're at 15 million. Sorry, now meaning technically 2025 and 2026. We're stamping the 15 million per person. The current law is we're doubling a 7 that grew with inflation. So now we're jumping it all the way to 15 million per person. And portability is in there, meaning each spouse has 15 million. That's 30 million. Okay. Before you have to worry about federal estate taxes. Okay, married couple, 15 million each. One passes away, the survivor has to file a piece of paper with her the death tax return, as we call it. And this one will inherit their 15 million exemption, making it double for the surviving spouse to 30. That's what portability is. Now, this is for federal estate taxes. States have separate estate taxes, and the feds say you can actually deduct dollar for dollar any state estate tax owed. So if you owed the state 10%, dollar for dollar, you can reduce it from what you owe the feds. And a lot of the states don't have portability, meaning one person passes away, you don't inherit the other's exemption. Okay? So speaking of states, here you go. I updated this the best that I could. When I updated it, it was late 2025. So as far as I see for 26, unless any changes occur after I created this, here's where we're at. Like Washington just did some updates, and they are very specifically saying it's not portable. So it's 3 million per person. But the surviving spouse cannot inherit their 3 million. But boy, did they jump some of this taxation, 10 to 35%. So I bring up Washington because my parents are in Washington, and we're looking at their estate plan because they just updated a lot of rules, and we got to make sure that they're ready to go on that type of stuff. So Connecticut, DC, Hawaii, Illinois, these are all alphabetical here. They all have their own estate taxes. Iowa repealed theirs finally. They have no estate tax. So these are on top of the federals. But what you'll notice here, feds are 15 million each. Well, these have lower exemptions, and there's some weird inheritance taxes you've got to be very careful of. Like Pennsylvania starts at 0, meaning every single dollar may be exposed to inheritance taxes. And a lot of the times that'll be dependent on beneficiaries. If it's blood, meaning blood relatives, then they might exclude it, or just children, biological children, they might exclude the inheritance tax. So you have to look at each state's rules. But the reality is this is based on your primary residence. It's real property. And when we say real property, we're talking about real estate, right? So my mother-in-law, she was a resident, a primary residence in Minnesota. That's what she claimed. But she had lived here 5 years before she became incapacitated with Alzheimer's. Her driver's license was still in Minnesota. The address on her tax return was still in Minnesota. So then the argument is, where was her primary residence? And that's what you want to choose, right? In her case, Minnesota had a state estate tax. Well, she didn't, at time of her passing, she certainly didn't have 3 million. I would have said she was pretty darn close. So she needed to switch her primary residence to Arizona, because guess what? Arizona doesn't have a state estate tax. And back then, Minnesota was closer to 1 million, if I remember correctly, when she did this. And I caught that and said, but you live here. This is your primary residence. And you want it to be because you're subject to state estate taxes in Minnesota, whereas down here, you're not subject to any state estate tax. So making sure you understand where your primary residence is. And that's usually going to be based on things like what address is on your tax return, what address is on your driver's license, those kinds of things, the basic things. You can have a house in both states, but the state that has your non-primary residence house, rental property, second home, whatever you want to call it, that house will be subject to that state's, but that's it. Everything else is determined by your state estate tax. So that's important. Understanding real estate matters when it comes to state estate taxes. If it's not your primary residence, they can only tax what's in their state. If it's under these dollar amounts, then you're fine. Okay. Charitable remainder trust. So some fun trusts you can do if you're very charitable oriented. Maybe you don't have heirs and you want to benefit from charitable activity now. knowing that all your money is going to go to charities after you pass away, a charitable remainder trust can be a great thing. You get to use it now, and whatever's left over goes to charities, and you get income tax deductions. You get to avoid capital gains tax. There's lots of wonderful stuff that you can utilize here while you're alive, knowing that this is all going to charities later. You want to know how the billionaires are going to pass their wealth without taxation? Charitable lead trust. This is kind of cool. So you plunk down a huge amount of money in a foundation like the Bill Gates Foundation or the Clinton Foundation. All these foundations, this is what they're doing. They're doing lots of good. This money sits in there. Okay, it's invested. It's growing. Okay, instead of using all this money for charitable activity, it is there earning, using the profits. And I'll show this here. Using the profits, sending them off to charitable activities. So here in this example, donor gives $1 billion. Okay, let's say it's invested, and just for math, let's say it's earning 8% a year. Well, in my example here, they're taking half the earnings. So just 4%, half the earnings. So the $1 billion is sitting in there still growing. They're taking some of the money and using it for charitable activities. Mathematically, after 18 years, over $1 billion, more than what they donated, went to charitable activities. Here's the trick. Now, once it matches how much they put in there, it can be released to the heirs. All the money left in that account can be released to heirs, tax-free, estate tax-free too, right? So when Warren Buffett gives half his net worth to the Bill Gates Foundation, I'm not saying he's not doing this, but this is what they're all doing. This is how they're avoiding it. When you're a billionaire, you can afford to do stuff like this. You can take half your net worth, put it in a charitable remainder trust or these foundations. You know, that's really what these things are. These sub accounts are charitable, not charitable remainder, sorry, charitable lead trusts. And the lead part means I'm giving to charities now. I'm using the principal to earn more money, and I'm sending some of those earnings off to charitable activities. I'm meeting the rules, then it can get slipped over to my heirs after I'm gone, after 18 years in that example. Here's the very useful one for a lot of normal people. This is, what you use in some of these states that don't have portability. Maybe you have anybody in that 15 million plus net worth. That includes your house. That includes everything, right? If you're pushing 15 million, you should be thinking about this because it helps separate those dollars upon your passing. Okay, so if you have a married couple, great example, late life marriage, you have your own separate kids, separate heirs, but you want to take care of the surviving spouse. One passes away, you put the house in there, you put all your money in there, you split up the net worth, and you say, hey, this trust of mine of the deceased, the surviving spouse can use it for this, and this. They get required distributions. They get this, they get this. You can give them money all along the way. They get to use the house as long as you're both alive. And then when the surviving spouse passes away, the rest of the net worth goes in here and it splits up the way the trust tells it. So it separates your net worth, taking care of the surviving spouse. So this creates portability. In a state like Washington, where it's 3 million, if you're at 4 million net worth, then you can put 2 million of it in the first to dies trust, leaving only 2 million left in the second to dies trust. It's that simple. You're splitting up your net worth, creating the portability that a lot of these states don't allow. Wonders of legal paperwork. Let's see, irrevocable life insurance trust. When you want to leave life insurance benefits to heirs, if you want to make it not part of your estate, you create it in an irrevocable life insurance trust. You gift money to pay for that life insurance, and then the death benefit gets dispersed outside of your estate, not part of the estate tax. Gifting, we're up to $19,000 a year. What if I give 20? Nothing happens. They reduce your 15 million by $1,000 if you report it properly. That's all. Yeah, my great aunt, when she moved into long-term care, she wrote a $700,000 check to my mother, technically, who was her sole heir and going to provide all the help to care for her. So my mom and dad took care of her until she passed. They paid all the bills, and the nice thing in her case was they got the tax deduction for paying for long-term care for somebody they were in charge of. They claimed her as a dependent. But the gifting side of this, she gifted 700,000 all at once while she was alive. Oh, you can't do that. Yes, you can. You can gift up to $15 million before anybody has any care. So they reduced her lifetime exemption by the 700,000. Well, that was her entire net worth at that point. So everything was fine. Okay. So the annual gifting just says, do I have to report it or not? That's all it is. If you gift 19,000 to 20 people, you don't have to report a penny of it. Okay? You don't have to report any of it. The other thing you don't have to report is if you're paying medical and educational expenses directly. So your grandchild is in the hospital with a broken leg and the parents don't have health insurance and they need help pay the bill directly to the hospital, and you won't have to report it as a gift. Same thing for college education or any education for that matter. If you want to bribe your granddaughter's way into Stanford, you can write them a $250,000 check and you don't have to tell anybody. Yes, that stuff has been going on. Gifting in terms of 529s, they allow you to put up to 5 years all at once. So if you're behind, maybe you're retired, you started realizing you have more money than you need for yourself, and you decide to find a way to transfer some of this to your grandchildren or great-grandchildren. You can put, as a single donor, 529, you can set up a 529 with 95,000. If you're married, that's 95,000 each, so 190,000 in one swoop. And perfect. You don't have to report it to anybody. It all works out. You just put it in the 529. In some states, you get to write that off on your tax return. So that's a nice little write-off there. So when we start looking at this from the big picture, create your documents now if you haven't. If you didn't get that out of this, look, you got to do it before something happens. And when can something happen? Well, anything can happen at any point. So create some backups. Make sure all of your accounts have beneficiaries on them at minimum. All right. Create a will to back things up when you're young. And then as things get complicated, create a trust. List your beneficiaries properly. So important. Beneficiaries are more important than anything as far as I'm concerned. Making sure anything and everything that you can put a beneficiary on, you do. Will-based plans are best for most. Save money, use the internet if you have a knowledgeable financial. If your advisor is not willing to have these discussions with you, you don't have a good financial advisor. This is something that they should be addressing with you. Fund your trust. Fund your trust. If you get a trust, you're not done. You have to go through and change the ownership. You have to go through and name the beneficiaries. You have to go through and do things. Utilize trusts for the following common reason: large estates over the federal exemption or even your state exemptions to get through the state taxes there. Real estate in multiple states. It's very helpful to have a trust get this cleaned up and transferred. Family business, difficult family dynamics. There's lots of complications that come up in people's lives that then require to adjusting to a trust. But at a minimum, in your younger years, just beneficiaries and a basic will, especially when you have children that are minors. You have to name somebody in charge of that minor when you pass away. So understand, retirement planning is not just investing the money. It's, simple things like having beneficiaries listed properly. I hate lazy advisors that don't fill things out properly. Be honest about where you are and where you want to be. Set goals, educate yourself, develop a strategy, inspect what you expect, and consult with knowledgeable, unbiased advisors. So, public Zoom, January's class, Harnessing the Power of Roth. That's right, we've got the Roth class. It was very popular last year. It was brand new last year, and I'm working on updating that and cleaning it up and making it fresh and new for this year. So make sure you're there. The great Zoom schedule we put together, there's four opportunities plus a Q&A at the end of every single month. Remember, I'm skipping December's Q&A. I'll be out for the holidays through Christmas, all the way through New Year. So first Tuesdays, 10 a.m. And again, remember, this is West Coast time, Pacific, LA time, Seattle time, the West Coast time zone. So first Tuesdays, 10 a.m., second Saturdays, 10 a.m., second Wednesdays, 2 p.m., third Thursdays, 4 p.m., and then the end of the month Q&As, 4 p.m. There are all the important websites. Go to that YouTube channel, subscribe, take a look at some of these videos. You can look at anything and everything. They're searchable. You can put any topic in there and it'll bring up any videos that pertain. It's a pretty cool website once you figure it out. It's a whole channel based on my head and anything I can come up with. Again, the nonprofit is fpfeaz.org. Go find the full schedule there and subscribe, or not subscribe, but register for classes. Go look at that on-demand stuff. SESweb.net has lots of great on-demand stuff as well. If you want to meet with me for any reason, yourinvestmentcounselor.com, yourinvestmentcounselor.com. You can go on there and schedule a free meet and greet with me as well. I love all this stuff, and I can help with documents if needed. And always happy to have the pertinent discussions to figure it out as well. So always happy to help. Give me a call, 800-345, shoot me an email, contact us, or jump on Your Investment Counselor and schedule that appointment. When you're in person, you get a nice little evaluation. So if you're in Arizona and you want to come see me in person, check out FPFEAZ. You can also get a copy of the slides when you come to them in person. I can't hand them out when it's online, but I can hand them out when it's in person as well. So again, fpfeaz.org to find the full schedule out there. If you're just here visiting as a snowbird, come see me in person. I always love meeting people from all over. It's fun to hear from people even when they're on vacation. Vacation? Come to financial education? Yeah, people are doing it. It's very it's fun. I meet people from Minnesota and Wisconsin all the time. I have a lot of Minnesotans and Wisconsins here. So hope to see you soon. Thanks again. Hang out for a second and answer any questions that may follow. A quick little survey. If you want anything from me, you can get a copy of this, a link to watch a copy of this, or ask for an appointment or anything like that. All right, everybody. Thanks again. We'll see you soon.